Hi dear traders! Last week traders were cautiously observing the situation in the US banking sector. The US banking crisis has already posed challenges to European banks. Meanwhile, the biggest banks in the US stepped up their effort to bail out First Republic Bank to calm down deposit holders. Yet investors realize that these attempts have only a short-term effect. The bank crisis is far from being over. Let's discuss how financial instruments closed last week. As you know, the US dollar is considered to be the #1 safe haven asset, so as a rule, demand for the greenback rises during market turmoil and uncertainty. But not this time. When the US banking sector is under threat, the US Federal Reserve is ready to resume the quantitative easing program, or in other words, start printing dollars, which is a negative factor for the currency. Besides, investors are looking ahead for the FOMC meeting this Wednesday. The regulator is projected to ease its stance on monetary policy. Given the recent banking collapse and a slowdown in inflation, the Fed may raise the rate by 25 basis points to 5%. Meanwhile, the European Central Bank raised its rate by 50 basis points at the meeting on Thursday, despite the current uncertainty. The ECB officials noted that the European banking sector was resilient and that they were monitoring currency market tensions closely. The European regulator is ready to take whatever action needed to ensure price and financial stability in the region. Against this background, the euro managed to win back some losses against the US dollar. The contagion of the US banking sector crisis spread to Europe, and Swiss bank credit was on the brink of bankruptcy. The weekly closing price of the euro-dollar pair ended up at the opening level of 1.07. Woes around the spreading banking crisis have affected the British pound as well. Traders are waiting for the central bank to meeting on Thursday. The Bank of England is expected to raise the interest rate by another 25 basis points. Inflation in the UK is still running high, which is why the regulator has to take measures to combat it. In the meantime, the UK Chancellor of the Executive, Jeremy Hunt, pledged to have inflation reduce the national debt and grow the economy. He believes that Great Britain will avoid a technical recession and will see inflation fall to 2.9% by the end of 2023. Yet investors seem to downplay such an optimistic forecast. Over the week, the pound sterling gained 0.9% against the greenback. Meanwhile, Japan looks like the safest place in the current market turmoil. The Bank of Japan is keeping its rate in the negative zone to support businesses in the fight against inflation. That is why Japanese banks have no reason to fear bankruptcy due to low liquidity. The yen has finally appreciated against the US dollar and regained 1.79% over the past week. Gold traders also benefited from the current market situation. Over the past week, gold rose by 5.3%, its highest gain in the past 4.5 months. At the end of the trading week, gold was seen trading at $1,980 per troy ounce, which is the highest level since April 2022. The banking collapse has awoken fears of a recession, which means that global central banks may ease their monetary approaches. Lower interest rates make gold more attractive to investors. In the commodities sector, oil traders saw the biggest losses last week. Brent crude dropped by 12.5% below $73 per barrel, hitting its lowest level since December 2021. Investors are closely monitoring the decision of the OPEC Plus deal members. Saudi Arabia and Russia are discussing ways to maintain stability and market balance. The Saudi energy minister recently said that OPEC Plus will stick to the oil output deal agreed in October and will maintain it until the end of this year. Markets hope for crude demand recovery in China, and OPEC has also raised its forecast for growth in oil demand in China in 2023. These are the trends of the last trading week. The new week is expected to be full of important events. Stay tuned, follow our daily news reports to be always in touch with the latest events. See you!